NPV equals the sum from t equals 0 to n of c sub t divided by open parenthesis 1 plus r close parenthesis to the t power. Net present value, NPV, measures the value added to a firm by a project after moving every cash flow to today's dollars. Think of it as a scale that tells you how much money you would have if you could magically travel back in time and deposit each future cash flow at a safe interest rate. C sub t is the cash flow at period t. C0 is usually the initial investment, a negative number. R is the discount rate, the firm's required rate of return or cost of capital. N is the number of periods. If NPV is positive, the project adds value. If it is 0, the project breaks even. If it is negative, the project destroys value. A simple analogy: imagine you are offered a series of payments over the next few years. To decide if you should take the deal, you ask, how much would these future payments be worth if I had them today? The discount factor open parenthesis 1 plus r close parenthesis to the t shrinks each future dollar to its present-day equivalent. Just like how a $100 bill you receive next year is worth less than $100 in hand today because you could have earned interest on it. The internal rate of return, IRR, is the discount rate that makes the net present value of a project exactly 0. In other words, it is the break-even rate of return earned by the cash flows. Mathematically, it solves the equation. 0 equals the sum from t equals 0 to n of c sub t divided by open parenthesis 1 plus IRR close parenthesis to the t. IRR is expressed as a percentage and can be thought of as the interest rate that the project itself generates. Imagine you put money in a bank account that pays a certain interest rate. The IRR tells you what that rate would have to be for the account balance after all deposits and withdrawals to end up at 0. That is, you get exactly back what you put in, no more, no less. To find IRR, you usually use trial and error, a financial calculator or spreadsheet software, because the equation cannot be solved algebraically for most cash flow patterns. It requires solving a polynomial of degree n. Decision rules. NPV rule: accept the project if NPV greater than 0, reject if NPV less than 0. When comparing mutually exclusive projects, choose the one with the highest NPV because it adds the most dollar value to the firm. IRR rule: accept the project if IRR greater than required rate of return hurdle rate, reject if IRR less than hurdle. For mutually exclusive projects, pick the one with the higher IRR provided the projects are of similar size and timing. Ranking criteria. NPV ranking is absolute. It tells you how many dollars of wealth are created. It works regardless of project scale, timing, or cash flow pattern. IRR ranking is relative. It tells you the percentage return. It can be misleading when projects differ in size, lifespan, or cash flow timing, because a small project with a very high percentage may still create less wealth than a larger project with a modest percentage. In practice, most finance textbooks and firms treat NPV as the decisive metric. IRR is used mainly for quick checks or communication with non-financial managers who like percentage figures. Conflicting rankings arise most often in 3 situations. Different scale: Project A requires $1 million and yields an NPV of $150,000, IRR approximately 12%. Project B requires $100,000 and yields an NPV of $20,000, IRR approximately 25%. IRR says B is better, but NPV says A adds more dollars. Different timing: a project that pays big cash flows early will have a higher IRR than a project that pays the same total amount but later, even though the later paying project might have a higher NPV at the firm's discount rate. Reinvestment assumption gap: IRR implicitly assumes that interim cash flows can be reinvested at the IRR itself, often an unrealistically high rate. If the realistic reinvestment rate is lower, for example the firm's cost of capital, the IRR-based ranking can be overly optimistic, while NPV, which assumes reinvestment at the discount rate, gives a more reliable ranking. When these conflicts appear, finance theory recommends following the NPV rule because it directly measures value creation for shareholders. Explanation: a non-conventional cash flow pattern is one where the sign of the cash flow changes more than once. For example, an initial outflow, then an inflow, then another outflow. Each sign change can create an additional root of the IRR equation, leading to multiple IRRs. Example, C0 equals minus $100, C1 equals $230, C2 equals minus $150. The IRR equation becomes 0 equals minus 100 divided by 1 plus IRR to the 0 plus 230 divided by 1 plus IRR to the 1 minus 150 divided by 1 plus IRR to the 2. Solving this quadratic may give two positive rates, say 5% and 45%. Which one is the IRR? The answer is none of them uniquely represents the project's return, and reliance on IRR becomes dangerous. Handling strategies. Use NPV as the primary decision metric. It is single-valued regardless of cash flow signs. Apply the modified IRR, MIRR, which forces a single solution by assuming a single reinvestment rate for positive cash flows and a single finance rate for negative cash flows. Plot the NPV profile, NPV versus discount rate. Where the curve crosses the horizontal axis are the IRRs. The shape of the curve shows whether multiple crossings exist. The key takeaway: when cash flows change direction, treat IRR with caution and prefer NPV or MIRR. The modified internal rate of return, MIRR, resolves two major weaknesses of the traditional IRR: the multiple IRR problem and the unrealistic reinvestment rate assumption. MIRR is calculated in 3 steps. Step 1. Discount all negative cash flows back to present value using the firm's financing rate, RF. Present value of negatives equals the sum over T, where CT is less than 0 of CT divided by 1 plus RF raised to the T. Step 2. Compound all positive cash flows forward to the end of the project using a reinvestment rate, RR, often the firm's cost of capital. Future value of positives equals the sum over T, where CT is greater than 0 of CT times 1 plus RR raised to the n minus T. Step 3. Solve for the rate that equates the future value of positives to the present value of negatives over the project life, n. MIRR equals the fraction of future value of positives over negative present value of negatives, raised to the power 1 over n minus 1. Comparison with NPV. MIRR expresses the project's return as a single percentage, making it easier to compare with a hurdle rate. Unlike traditional IRR, MIRR assumes realistic reinvestment at RR rather than at the IRR itself. NPV still remains the most direct measure of value added. MIRR is useful for communication and for ranking projects when a single rate is needed. Practical analogy. Think of a farmer who invests money negative cash flows to plant crops and later harvests positive cash flows. The farmer cannot instantly reinvest the harvest at the same high return rate he earned on the crops. He can only reinvest the money at the prevailing market interest rate. MIRR captures this realistic reinvestment behavior. Explanation. The core difference between NPV and IRR lies in their reinvestment rate assumptions. NPV assumes that any intermediate cash flows are reinvested at the discount rate R used to compute the NPV. This rate is usually the firm's weighted average cost of capital, WACC, and reflects the opportunity cost of capital. IRR implicitly assumes that interim cash flows can be reinvested at the IRR itself, which is often much higher than the firm's realistic reinvestment rate. Why does this matter? Suppose a project generates a large cash flow early on. Under the IRR assumption, you would be able to take that cash flow and earn the same high IRR on it, dramatically inflating the projected wealth. In reality, you can only earn the market rate, WACC. Therefore, NPV gives a more accurate picture of the total value created, while IRR can overstate it. Illustrative example. A project of $1,000 initial outlay yields $600 at the end of year 1 and $400 at the end of year 2. With a WACC of 10%, the NPV is NPV equals negative 1,000 plus 600 divided by 1.10 plus 400 divided by 1.10 squared equals negative 1,000 plus 545.45 plus 330.58 equals negative 123.97. The IRR solves negative 1,000 plus 600 divided by 1 plus IRR plus 400 divided by 1 plus IRR squared equals 0. giving IRR approximately 15.2%. If we could truly reinvest the $600 at 15.2% for 1 year, the total wealth would be higher. But the firm can only invest at 10%, so the NPV correctly shows a loss. Explanation: sensitivity analysis examines how the NPV and indirectly the decision changes when the discount rate varies. The NPV rate profile is a curve that typically slopes downward. As the discount rate rises, future cash flows are worth less, so NPV falls. Effect on NPV: small changes in the discount rate can flip NPV from positive to negative for projects with cash flows far in the future, high-duration projects. Managers therefore test a range of rates, for example 8% to 12%, to see how robust the decision is. Effect on IRR: the IRR itself does not change with the discount rate, it is a property of the cash flow pattern. However, the decision based on IRR does change because the hurdle rate, the discount rate you compare IRR to, changes. If the hurdle rises above the IRR, the project is rejected, even though the IRR value stays the same. Practical analogy: imagine you are weighing a stack of bricks' future cash flows. The heavier the bricks, the more the stack tips the scale. Higher NPV changing the discount rate is like swapping the scale's springs for stiffer or softer ones. The tilt changes even though the bricks themselves haven't. Typical sensitivity table. Discount rate to NPV: 8% equals $45,000. 10% base equals $30,000. 12% equals $16,000. 14% equals $2,500. If the firm's cost of capital is anywhere between 8% and 12%, the project remains attractive. At 14%, it becomes marginal. Thus, sensitivity analysis adds a layer of confidence that the NPV decision is not overly dependent on a single discount rate estimate. NPV calculation. NPV equals negative 1200 plus 500 divided by 1.10 to the power 1 plus 600 divided by 1.10 squared plus 400 divided by 1.10 cubed. 500 divided by 1.10 equals 454.55. 600 divided by 1.10 squared equals 600, divided by 1.21 equals 495.87. 400 divided by 1.10 cubed equals 400 divided by 1.331 equals 300.53. NPV equals negative 1200 plus 454.55 plus 495.87 plus 300.53 equals $50.95,000, approximately $51,000. Since NPV is greater than 0, the project adds value. IRR calculations. 0 equals negative 1200 plus 500 divided by 1 plus r plus 600 divided by 1 plus r squared plus 400 divided by 1 plus r cubed. Multiply both sides by 1 plus r cubed. 0 equals negative 1200 times 1 plus r cubed plus 500 times 1 plus r squared plus 600 times 1 plus r plus 400. Expand 1 plus r cubed equals 1 plus 3r plus 3r squared plus r cubed. Solve numerically using trial and error. R equals 8% gives NPV equals negative 1200 plus 500 divided by 1.08 plus 600 divided by 1.08 squared plus 400 divided by 1.08 cubed equals 94.91. Positive, therefore internal rate of return is greater than 8%. R equals 12% gives NPV equals negative 1200 plus 500 divided by 1.12 plus 600 divided by 1.12 squared plus 400 divided by 1.12 cubed equals 10.29. Positive. Therefore, internal rate of return is greater than 12%. R equals 14% gives NPV equals negative 1200 plus 500 divided by 1.14 plus 600 divided by 1.14 squared plus 400 divided by 1.14 cubed equals negative 29.60. Negative, therefore internal rate of return is less than 14%. R equals 13% gives NPV approximately equals negative 1200 plus 442.48 plus 470.37 plus 277.50 equals negative 9.65. Negative. R equals 12.5% gives NPV approximately equals negative 1200 plus 444.45 plus 474.68 plus 281.10 equals 0.23, approximately 0. Thus, internal rate of return is approximately 12.5%. Decision comparison. Using the NPV rule with cost of capital 10%, NPV equals plus $51,000, therefore accept the project. Using the IRR rule, internal rate of return 12.5% is greater than 10%, therefore accept the project. Both methods agree because the cash flows are conventional with only one sign change, and the internal rate of return exceeds the discount rate. If the hurdle were 13%, NPV would still be positive, but internal rate of return 12.5% would be below the hurdle, creating a conflict. Finance theory advises to follow NPV because it measures actual dollar value added. Key takeaway: calculate NPV for a definitive answer. Use IRR as a quick sanity check, but be aware of its assumptions and possible conflicts.